Hello and welcome to Macrosutra. This is Akanksha Mishra. The International Monetary Fund has come out with a highly anticipated World Economic Outlook for April a few days ago. And to discuss that, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you for being with us, Radhika.
Thank you, Akanksha.
Now, let's get right into it. How have the recent tariff announcements by Trump impacted global growth projections? And this time, what are some of the scenarios that IMF is taking into account while making its projections?
Yeah, so this is, as you rightly pointed out, one of the most anticipated reports because it tells us the impact of tariffs and other disruptions on global growth outlook. So, as we all know, the IMF comes up with this World Economic Outlook report in April and October. And in the month of January, they come up with an update, which is just to revise their projections about global growth and country specific projections. Now, this time around, because there's so much of uncertainty and because there's so much of flip flops happening on tariffs, that is why this time in the IMF's World Economic Outlook has come up with three scenarios of growth projection. One is the reference forecast, and then there are two alternative scenarios. So we'll stick to the reference forecast, which takes into account the developments in the US till 4th of April. So, from February till April, whatever tariff announcements were made, all those changes are incorporated when they are talking about their global growth projections. But we know that after 4th of April, they put a pause on the rollout of tariffs. So, there is another alternative projection which takes into account the developments after 4th of April, and then there is another scenario which takes into account the developments prior to 4th of April. So there is 4th up till 4th of April, prior to 4th of April and after 4th of April. So the tariff developments between February to April are incorporated in the reference forecast. And if we look at that, we see that global growth is projected to fall to 2.8% this year, uh, and this is a sharp decline from what was projected earlier for the global growth. So there is a 0.5% decline. So as I said, in January also the IMF came up with its projection for the current year to 2025, and that time the growth projected was 3.3%, and now the growth that is projected is 2.8%. So clearly there is some impact of tariff that is causing the sharp slide in growth projection for the global economy. And as I said, if they don't take into account the impact of tariffs, which is like one of the alternate scenarios applicable prior to 4th of April, then the global growth projection is 3.2. So there's hardly any hit to growth from 3.3 to 3.2. But when this Liberation Day tariffs are taken into account in the global growth projection, then growth is expected to decline to 2.8% globally. Now, what is interesting to note is that there are substantial country variations in this growth, because global means it includes advanced economies, it includes emerging economies, and so on. And there we see that the maximum hit to growth in obvious terms is shown for the US, because the US is the implementing country for tariffs, and for the US it's a supply shock, because tariffs mean that you are restricting the supply of low cost competitive goods into your economy. So it's a supply shock which could lead to increase in prices, increase in costs, and therefore the growth is likely to be hit. So for the US, growth is expected to decline by 1% as compared to last year. So now growth is expected at 1.8%. Till last year, we were talking about very robust growth in the US. We were talking about exceptionalism, because all advanced economies growth was slowing and only US growth was rising. Now that exceptionalism narrative has taken a beating because of the tariffs, and the US economy is expected to slow down by 1 percentage point from 2.8% in 2024 to 1.8% in 2025.
Right.
And similarly, China is also expected to slow down from 5 to 4%. But for India, they have projected a very small marginal decline by 30 basis points from 6.5 to 6.2%. And it's in line with RBI's projection is 6.5%. So it's not a very major hit to the Indian economy, but yes, on US and China, there is a decline.
Right. So we looked at US and China and obviously India's growth projections. Are there any other regions for whom the growth rate differs from the global growth rate? Like what about Europe?
Yeah, so for Europe also there is a decline, but not to a very great extent. So as I said, the maximum hit is on the US, and then China, and on the EU also there is a hit. But as we discussed in our previous episodes, EU has introduced a large fiscal stimulus program. Particularly Germany has introduced a stimulus program to boost its spending on infrastructure, on defense, on military, and on climate, and that is expected to give some boost to growth. So therefore there are these offsetting factors. There are some factors that will uplift the growth, there are some factors that will put the growth down, but overall the extent of the impact is not too much. There's only a very marginal decline that is projected for the EU, just like for India, and the maximum hit is expected for America and China. And we can debate whether even that they are realistic or not, because
Right.
there are other projections which say that America may enter into recession. But yeah, that is one thing, that is what the IMF is saying.
And yeah, that's what I want to get into, which is that you say that the IMF is being cautiously optimistic in its US projections. So, how is the IMF's growth projection for US different from other private forecasters?
Right. So that is important, and we've talked about this last time also. That one is the Federal Reserve Bank of Atlanta has been projecting recession for the January to March quarter, and various other private institutions like Goldman Sachs, JP Morgan, they have upped their probability of recession in the US for this year by a considerable margin. In fact, even after the pausing of the reciprocal tariffs, they still expect recession probability to be somewhere between 50 to 60% in the US, which is a sharp jump from the earlier period where the probability of recession was hardly 20 to 25%. So there is a probability of recession. And in fact, interestingly, this question was raised in the press conference when the IMF World Economic Outlook was released 2 days back. It was raised that you are not the authors of the report were asked that aren't you featuring, or you are not expecting a recession scenario in the US, and the response given by the authors of the World Economic Outlook is that they expect that the labor market is
Hmm.
still quite strong in the US, and therefore they don't foresee
Hmm.
recession in the immediate term, and it will all depend on how the tariff negotiations pan out, what happens to US China trade war, whether there is escalation or de-escalation. So that is why right now they are not considering, because they feel that US is coming from a very strong growth,
Yeah.
and therefore immediately there is no sign of recession. But as I said, there are several indicators within the US, the official statistics, that do point out to a sharp slump in
Right.
consumer confidence, sharp increase in inflation expectation, which will hamper growth prospects in the US.
Now, it's not just growth that we need to be worried about. There's also other macroeconomic variables. So
Correct. Yeah.
there's investment, there's government debt,
Hmm.
and fiscal deficits also. According to the IMF's projection, how are the tariffs going to influence that in the US?
Yes, that's very important, because, as you rightly said, it's not the growth projection, though we talk only about growth numbers. The WEO database, the World Economic Outlook database, is very rich, and it tells us about countries' fiscal deficit, current account deficit, debt to GDP ratio, savings, investments, and so on. And if we focus on some of the macro numbers for the US economy, we see some things are problematic. For example, what the data is projecting about investment is that it's not going to rise in the near future. From 2024 to 2026, actually, the IMF World Economic Outlook is projecting a moderation in investment rate in the US. And at the same time, it is projecting an increase in savings rate. So while savings are rising, going to
Hmm.
rise in the US as per the IMF World Economic Outlook, they are not going to translate into higher investments.
Right.
And now, if one of the stated objectives of the tariffs imposition is to increase the level of investment in the US, is to increase manufacturing investment in the US, that doesn't seem to be corroborated by the data that is put out by the IMF World Economic Outlook. So that is something problematic, that okay, you are imposing tariffs, but the projections by the IMF do not show that 2 years down the line there's going to be some increase in perceptible increase in investment. Of course, investments take time, but at least in 2 years you should see some impact.
Yeah.
But what we are seeing in the data is that actually there is a decline in investment. So that is number one. The other concerning element of the macro data of the US is that they are projecting an increase in debt to GDP ratio for the US, and it's going to escalate to somewhere around 123%, above 120% of GDP. Fiscal deficit is on the welcome side, it's expected to decline, but again that is uncertain,
Yeah.
because it depends upon whether from tariffs you are going to get revenues or not, because one of the objectives of raising tariff is to get revenues and also
Yeah.
to protect your own domestic industry, the
Yeah.
US industry. Now, if tariffs rise a lot, then the import demand will fall. And depending upon the elasticity of demand, if the prices rise too much, the imports will fall. And if imports fall, then tariff increase will not culminate into higher
Yeah.
revenues. And if they do not culminate into higher revenues, then the deficit is not expected to improve. So it's not very clear whether tariffs will lead to a sharp improvement in the fiscal deficit of the US economy. So these are some instances of some uncertainty that is still lingering in the US macro projection. The impact of tariff on investment, the impact of tariff on fiscal deficit. These are two important things that we need to see, because there is some inherent level of inconsistency in this data.
Right. Now, the IMF also provides inflation trends
Correct.
information,
Yes.
and this time what's been noticed is that there's differing trends for inflation for different kinds of economies.
Right.
So can we get into the inflation projections for advanced economies versus emerging economies?
Right. So that's again a very notable feature of the report this time, that it's talking about divergent inflation paths. Normally, we see that inflation tends to be synchronous, that is,
Yeah.
in both emerging economies and advanced economies, it tends to follow a uniform kind of trajectory. But this time around, because the impact of tariff is going to be different on the tariffed countries and the tariff imposing country,
Yeah.
as I said, for the US, the imposition of tariff is a supply shock, because they are going to face a reduction in supply because they have imposed tariffs. So the imports would be restricted. It's a supply shock for them, and that would lead to increase in prices. So in the US and other advanced economies, inflation is projected to rise, which is in sharp contrast to what we have seen in the previous years, where at least in advanced economies, inflation was not a problem. But now inflation seems to be edging up, though at moderate levels. But again, there is a reversal in direction. Now, advanced economies are seeing a pickup in inflation, whereas in emerging economies, which are mostly the tariffed nation, they are
Yeah.
going to face tariff. These are the countries that are going to face tariff as a demand shock, because their products are not going to be demanded in the US. So for them,
Yeah.
it's a demand shock. The demand for their products would be lower. As a result, the prices would be lower in these countries. So, inflation projection is lower for emerging economies, and for advanced economies, it is above. And therefore, when we see, the most contrasting trajectory is for the US and China,
Hmm.
where for the US is expected to rise sharply, and for China, it is expected to decelerate, because China is one country which is going to face the maximum demand shock. As of now, the impact of tariff is 245%. So China is going to face the maximum demand shock, and therefore, as of now, presently, the impact of tariff on inflation would be negative for China, because they're going to face a demand shock. Their products would be demanded less
Yeah.
in one of the main markets, which is the US. So in China, the prices are expected to decelerate, and in the US, prices are expected to rise. And now this has implications for monetary policy, and consequently for capital controls or capital flows. Because in the US now, the challenge is, and we've seen this that there were instances, there were these news reports that US president is pressuring Federal Reserve chair to cut rates, whereas the Federal Reserve is more concerned about the impact of tariffs on inflation. They want to assess whether the impact of tariff will be a one-off impact, or whether it will have a second round impact. And so depending on whether it's a one-off impact, or if it's going to spill over, have second round impact, the monetary policy response will be different. If it's just a one off spike and then it dissipates, then they will go ahead and cut rates.
Yeah.
But if it is going to be something which is going to have a second round effect and third round effect, then they will be more cautious and they might even increase interest rates. So that is the policy conundrum for an advanced economy central bank. Whereas for emerging economy, India, China, these countries would have to reduce interest rates. So, and that has implications for capital flows, because interest rate differential will rise. In the US, it will be higher. In India and other EMs, it will be lower. So that has implications for global capital flow. So it's very these turbulent times, because of the asynchronous nature of inflation, asynchronous nature of monetary policy response. We could see differing capital flows trajectory.
Now, finally, what is the outlook on global public debt, and which countries are the major drivers of this trend?
Yeah, so it's very important to note that, while we keep talking about IMF's World Economic Outlook report, we should know that alongside this report, there are two more reports that are released by IMF. One is the Global Financial Stability Report, and the other is the IMF Fiscal Monitor. So, IMF Fiscal Monitor in particular talks about the fiscal side, which is the debt, the primary balance, the fiscal balance, and so on. And it's a very important to look at the fiscal monitor, because the growth outlook is not only influenced by tariffs, but the existing problems still exist. And one of the existing problems clouding the global growth outlook is elevated levels of global public debt. The public debt, which rose during COVID time, is still elevated. And this time around in 2025, global public debt is expected to rise from 93 to 95%. So it's expected to be a very sharp jump. And by 2030, it's expected to touch 100%. So global public debt to GDP ratio is expected to rise. And the pace of increase is very sharp from 2024 to 2025. But what is interesting to note is that this sharp jump is driven by a handful of economies. Again, the same very economies that are being problematic. We are seeing they are the economies that are driving the sharp surge in debt. US, UK, China, France, these are some of the economies that are driving the debt trajectory.
Yeah.
For India, the debt is expected to gradually reduce. So for India, that's a welcome step. And even excluding the US from advanced economies, the debt outlook is quite stable. So as I said, while the overall global public debt to GDP ratio is expected to rise, it is driven by a handful of economies. But there are two important points to note here. One is that going forward, the expenditure commitments of countries are going to rise, because they will have to spend additionally on this dislocation that is happening due to trade. They will have to spend additionally for reconfiguration of the disrupted supply chain. So expenditure commitments will rise, and that will have implications on the global debt. That is one. And the second is that those countries whose debt is denominated in dollar, they will have to be very careful, because we've seen that dollar has been very turbulent in recent days. So their debt outlook could worsen,
Yeah.
if dollar appreciates. Right now it is a relief for these countries, because dollar has weakened. We've seen that now dollar index has fallen even below 100. So that's a positive thing. So those are the two important things to note about the debt outlook. But overall, yes, debt is a problem, and overall debt outlook is expected to worsen.
Right. Now, I think it's time to take an audience question. So, there's one by Aditya who asks, do you think even after 90 days, if the Trump administration decides to either withdraw or further extend this cooling off period of tariffs, the IMF might revise the growth prediction, or will it remain the same? Also, how does a trade deal with the US give any added advantage to India in this tariff war?
So there are two parts to this question. One is about the 90-day tariff pause and how it impacts growth projection. So for this, even if we look at the present edition of the IMF's World Economic Outlook, we see that the second scenario that they're talking about, they have already taken into account the pause on tariff has already been taken into account, and even after taking that into account, global growth is not expected to pick up. Global growth projection is just 2.9%, and without the rollout, it is 2.8%.
Right.
The important point to note here is that the composition of this global growth of 2.9% is different from the composition of 2.8% when the rollout has not happened. Because when the rollout has happened, the growth outlook for those countries which are subject to a pause, that will brighten as compared to those where the projection, where the tariffs are still hold true.
Yeah.
So overall, even though the tariffs have been paused for 90 days, it doesn't change the overall growth outlook because the uncertainties still remain whether what will happen after 90 days. And that's the question which the IMF is also asking, but they are saying that the outlook going forward will depend on what happens after 90 days, whether there's going to be a de-escalation of the US China tension, whether it's going to escalate into a trade war, how India navigates through these challenges. So it's all will depend on various factors. But as of now, even taking into account the pause on the tariff rollout, the overall global growth outlook does not change materially. Only the composition within the global growth outlook could change. So that is point number one. The second question is about
How a trade deal with the US will give any added advantage to India in the tariff
yeah,
war.
so it could give added advantage in the sense that it may be that our reciprocal tariff, which is 26%, comes down if we are able to reduce our trade surplus with the US. Because the main grudge that the US has with all these countries,
Yeah.
including India, is that US has a big trade deficit.
Yeah.
And the reciprocal tariff, if you see 26%, or for Vietnam, it is above 40%, it's all based on trade deficit. Whatever is the trade deficit that US has with those countries, divided by 2 is the reciprocal tariff. So it's a very simple formulation that they have used for arriving at reciprocal tariffs. So if with these trade deals we have the opportunity to achieve quite a lot. One is that we should be able to reduce the reciprocal tariffs if we are able to provide greater market access, our market, to them. That is what they want, is that we should buy more from them. If we buy more oil from them, it won't affect our overall current account deficit, but our surplus with them will come down, and their deficit with us will come down. So that is one thing that will make them happy. Also, we could have some strategic alliances in certain sectors like semiconductors and other solar panels and so on, where other countries may be having a disadvantage. So these are some of the things that we can have a concession. Also in pharmaceuticals, where it's an inelastic demand for the US and we are a bigger supplier of pharmaceutical. So if we are able to secure exemption on certain sectors, it will be good for the country. So there are various things that we can do, but that will require a lot of domestic policy reforms as well, improving export logistics, providing concessions to exporters, scaling up manufacturing, and so on. But keeping all those domestic reforms into the picture, there is a lot that India can achieve, try to achieve, with this trade deal with the US.
And on that note, that's all we have for you. Thank you for tuning into The Print.